You joined a startup at 26, took below-market salary in exchange for stock options, and worked 70-hour weeks for 4 years. Then the company went public. On paper, overnight, you were worth $4 million. You'd made it. And then over the following 3 years, through a combination of decisions that seemed entirely reasonable at the time, most of it disappeared. This story plays out dozens of times with every significant tech IPO. Not because startup employees are financially naive. Because the psychology of paper wealth converts to real money in ways that almost nobody is prepared for. Today we go inside it. First, the mechanics. Most startup employees receive stock options, the right to buy shares at a predetermined price. Options vest over time, typically 4 years with a 1-year cliff. At IPO, the options can be exercised and the shares sold, but not immediately. Lockup periods of 90 to 180 days prevent insiders from selling at IPO, ostensibly to prevent market destabilization. During that lockup period, the stock price can move dramatically in either direction. The paper millionaire watches their net worth fluctuate by hundreds of thousands of dollars daily without being able to do anything about it. And when the lockup expires, the decisions made in that first week often determine whether the wealth survives. The lockup expiration is one of the highest stakes financial decisions most startup employees will ever make, and it arrives with zero preparation time and maximum emotional distortion. Sell everything immediately feels like abandoning the company, losing future upside, potentially triggering capital gains taxes all at once. Hold everything feels loyal, optimistic, but concentrates enormous wealth in a single volatile stock. The psychologically obvious decision, hold, because this company made you rich and will make you richer, is often the financially catastrophic one. Stocks that rise dramatically at IPO frequently correct significantly within 12 to 18 months. The paper millionaire who held through loyalty often becomes the person who watched $4 million become $800,000. Every financial principle of portfolio management says the same thing: concentrated positions in single stocks are high risk. Diversification exists precisely to protect against the company-specific risks that are impossible to predict: management failures, competitive disruption, fraud, regulatory changes, broader market corrections that disproportionately affect growth stocks. But startup employees arrive at liquidity with essentially 100% of their new wealth in a single stock, the one company they know better than any investor and therefore feel most confident holding. This familiarity is a cognitive trap. Knowing a company well doesn't protect you from the risks that come from outside it. And tech stocks, in particular, can lose 60, 70, or 80% of their value in market downturns. The most dramatic example of startup IPO wealth disappearing is the dot-com era of 1999 to 2001. Thousands of employees at companies like Pets.com, Webvan, and hundreds of others watched their stock options become worth millions on paper during the boom. Many held through the crash, believing in their companies, expecting recovery, emotionally unable to sell something that had generated such extraordinary paper gains. When the Nasdaq lost 78% of its value between 2000 and 2002, the paper millions became paper losses. Employees who had delayed salary, worked extreme hours, and bet their career on these companies often came out with less than they would have earned at a traditional job with normal compensation. The wealth was always conditional. Very few understood the conditions. Startup equity comes with significant tax complexity that catches many recipients completely unprepared. Incentive stock options and non-qualified stock options have different tax treatments. Early exercise elections, the 83B election, have strict 30-day filing windows and can dramatically reduce tax liability if filed correctly and catastrophically increase it if handled incorrectly. Alternative minimum tax implications of exercising ISOs can create six-figure tax bills. Capital gains timing decisions around holding periods affect the rate applied. Most startup employees encounter this complexity for the first time at the worst possible moment, when they're simultaneously processing the emotional experience of sudden wealth and facing irreversible financial decisions with multi-year consequences. Tech culture has a specific version of lifestyle inflation that makes post-IPO financial destruction particularly efficient. When your colleagues, who also just became millionaires, move to nicer apartments in more expensive neighborhoods, buy Teslas and weekend ski house shares, and start eating at restaurants you previously considered special occasion only on random Tuesdays, the social baseline shifts dramatically. Status comparison in tech communities after liquidity events tends to converge quickly upward. And because everyone around you is making the same lifestyle moves simultaneously, the behavior feels normal and affordable rather than risky and depleting. For many tech employees who experience IPO wealth, the natural next move is to repeat the process, join the next pre-IPO startup, take equity compensation, and compound the windfall. This logic is not irrational. But it creates a pattern where liquid wealth from one IPO is converted back to a liquid equity in the next company before it has been properly invested. The new startup may never go public. May go public at a lower valuation. May be acquired for less than expected. Or may simply fail. Meanwhile, the $4 million that could have been invested in diversified index funds is back at risk in a single private company, which is exactly where it started. The startup employees who successfully convert equity wealth into lasting financial security follow a consistent approach. They hire a fee-only fiduciary financial advisor and tax advisor before their lockup expires, not after. They develop a diversification plan that reduces single stock concentration to 10% or less of total portfolio within 12 months of liquidity. They sell enough immediately at lockup expiration to fund their lifestyle for 2 years without touching the remaining investments, removing financial pressure from future stock decisions. They invest the majority in boring diversified index funds. And they define their financial independence number, the amount needed to sustain their lifestyle indefinitely, and protect that amount before making any high-risk investments. Startup equity creates a specific mental accounting distortion. Because the wealth was earned through equity compensation rather than salary, it often doesn't feel like real money in the same way. It arrived all at once rather than incrementally. It's denominated in shares rather than dollars until the sale. And because it feels like found money, compensation for risk taken years earlier, it's mentally categorized as available for risk taking rather than as the financial foundation it represents. This mental accounting error causes people to treat IPO proceeds as play money rather than as the most significant wealth event of their financial lives, and to make decisions accordingly. Silicon Valley creates a specific financial trap that compounds the IPO wealth destruction problem: the cost of living. An engineer who became a paper millionaire in San Francisco or Seattle still faces housing costs of $4,000 to $6,000 per month for a modest apartment, food costs dramatically above national averages, and a social environment where the baseline spending for a middle-class lifestyle is significantly higher than anywhere else in the country. A $4 million portfolio generating 4% annually produces $160,000, which in San Francisco, after taxes, barely covers a comfortable but not extravagant lifestyle. The geography means the wealth threshold for genuine financial independence is dramatically higher than it would be elsewhere. You don't need to work at a startup to apply these lessons. Equity compensation in any form, stock options, RSUs, employee stock purchase plans, profit sharing, creates the same psychological and financial dynamics at different scales. The concentration risk. The tax complexity. The mental accounting distortions. The social pressure to spend among peers who received similar compensation. Understanding these dynamics and planning for them with professional help, before the liquidity event, not during it, is the difference between IPO wealth that lasts and IPO wealth that doesn't. Preparation converts luck into lasting security. The absence of preparation converts it back to nothing. Startup millionaires lose their wealth not because they're financially unsophisticated. They lose it because the conditions of their wealth creation, concentrated single stock positions, complex tax situations, extreme peer lifestyle inflation, and the psychological distortion of money that arrived through equity rather than salary, combine to create one of the most challenging wealth management environments that exists. The solution is not genius-level financial planning. It's preparation, professional guidance, diversification, and the discipline to treat IPO proceeds as the foundation of lifelong financial security rather than as the starting bankroll for the next bet. Are you working at a startup with equity compensation right now? Comment below and tell me what stage your company is at. If this video gave you information you needed, hit the like button. Subscribe and ring the bell so you never miss what's next. See you there.